Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest in Mr. Sam Hales. Sam is the founder and CEO of the Saratoga Group, a fund manager with a specialty in opportunity zones. Sam received his MBA from the Wharton School of Business, and he now has over 15 years of real estate and management experience. He has developed and purchased office buildings, industrial buildings, multifamily buildings, and even a boutique hotel. Since 2017, the focus at Saratoga Group has been the purchase, revitalization, and operation of mobile home parks. Sam, welcome to the show.
Thank you so much, Andrew. If I listen to that every morning, I think my ego would get a little inflated, but I appreciate the intro.
Yeah, no worries, man.
Yeah.
Can you, would you mind starting out by just telling our listeners a little bit about your background and how you got into manufactured housing?
Yeah, no, it's a good question. I think anybody that gets into manufactured housing always kicks themselves for not doing it sooner, right? So I've got a lot of years, as you mentioned, in real estate. First established Saratoga Group about 11 years ago, doing single-family homes. We raised a fund, actually money from China for that, and we're doing single-family homes in the Northern California area. And listen, that was a good time to be in real estate in general, and certainly in single-family homes, and there was great yield, and of course, we saw a lot of price appreciation. But price appreciation to the point that, to me, in terms of the yields, it just didn't make sense. And so we started looking around and kind of dabbling. And that's why you hear, the office building, the multifamily, some development, boutique hotel. We're just kind of dipping our toe in a few different areas, trying to find something we could both scale and also that made sense in all economic cycles. And anybody that's been through that exercise, at the end of the day, you probably come to two assets: self-storage and mobile home parks. And for us, we just felt, because of some of the moats around manufactured housing, that make it a lot more difficult for other people to, build another park or whatever, like you see in self-storage. You weren't going to have that competition over time. You got kind of a fixed supply and increasing demand. Just seemed like, great fundamentals for an investment thesis. So funny enough, I was actually kind of two different people in my life that turned me on to manufactured housing all at the same time. One of them was a buddy of mine, and he had another friend that's an operator in the space, and so he just kind of started feeding me a little bit. I'm like, man, I really need to look into this. And then the other one was actually our banker, who we'd done a lot of financing of these tranches of homes and things that we had bought or purchased, and they loved mobile home parks. Not all banks do, but this bank did, and so they were kind of nudging me as well. So yeah, that's and then once I started learning and finding out, I'm like, man, I should have done this like 7 years ago, but I'm going to try to make up for lost time. And that's what we've been doing. So in 3 years, we've purchased 26 communities.
Wow.
We actually have over 20 in contract right now.
Oh my goodness.
So our goal has been basically to double our lot count every year. And
Wow.
Obviously that gets very difficult at some point, but that would mean for us buying probably 5,000 pads next year.
Wow.
But we'll have closed on, probably about 3,500 this year.
Wow.
By the end of the year. So anyway, yeah, that's us. That's what we have going on.
That's fantastic. And are all of your communities in opportunity zones that you guys purchase?
No. So yeah, interesting thing that happened with the opportunity zones. Actually, another couple investments that we had were in a downtown area here in Northern California that was an opportunity zone. And so that's kind of how I found out about it and started looking into, hey, did it make sense for this multifamily investment that build out we were doing, and also this the boutique hotel. We didn't end up using OZ money for those projects, but once we started getting into mobile home parks, and I realized, well, hold on, this is those E requirements. I already knew those pretty well, and it's like, well, that's what we're doing, right? We're going in, we're investing in these communities, we're helping people that actually the legislation was designed to help. Often it doesn't, right? Because often you're building like really nice multifamily or a really nice hotel in maybe an area that's gentrifying or needs to be gentrified, needs some help, needs some money. I said that incorrectly. Not needs to be gentrified, right? But needs investment capital.
Sure.
But anyway, and it's like every mobile home park should probably be in an opportunity zone, because those are the folks that it was designed to help. So anyway, it would just seem like a great marriage, and so we started. We raised our first fund beginning of 2019 for opportunity zones and manufactured housing. We recently closed our second fund at about 16 million, and we'll probably launch our next fund, I'd say in the next 4 to 6 weeks, with a target raise of like 30 million. So,
oh my goodness, man! Wow, talk about massive growth. You guys must have a really big team to help explode like that. That's fantastic.
Yeah, we're trying to hire early, as they say, right? Because it's hard to make sure we're doing the right thing with everything we already have, not to mention what we're going to be buying. And so, so we're in the last 12 months, we actually we're looking at this just to kind of, because that's another way to look at the growth, right? So we've got about 17 new employees in the last 12 months.
Wow.
So
you need them. You got to have them.
We do. We'll probably have 30, 35 probably in the coming 12. So
that's great. Sam, what would you say is the hardest part about the mobile home park business in your eyes?
Well, good question. I think usually, sorry about the siren in the background. In the past, I would have said, and I think this is still true, but it's finding appropriate acquisition opportunities.
Mm-hmm.
Obviously, if we're doing an opportunity zone fund, then we've got that extra filter. And so, but just because it's in an opportunity zone doesn't mean we're necessarily going to buy it, right?
Yeah,
exactly. So we still have to go through all the underwriting criteria and make sure it's a decent area, and there's the economy and jobs to kind of support over the long term the investment. So, so when I look at if we're going to raise $30 million, we're typically pretty low leverage, especially in an OZ fund, but that's probably, $60 million worth of real estate at purchase. Is there that much available in opportunity zones? We think so. I mean, we were able to find we actually just are closing on our last deals in that $16 million fund, but that'll be 14 parks, and it took 9 months to find those, all told. But I think part of that is we knew what our capital constraints were. I think we could have done similar, we could have done maybe 50 to 100% more that met our criteria in the same amount of time if we knew that capital was available. So they're out there. They're definitely out there, but it takes, as you know, Andrew, it takes a lot of relationships, a lot of work, kind of finding those.
Finding them. And are you guys buying primarily through broker relationships, or is it, direct marketing to owners?
So we have a couple things in the OZ space. We call it the QOZ Finder, and it's basically a web bot that we developed.
Oh, nice.
Goes out and kind of scrubs the internet and finds mobile home communities that are in opportunity zones and kind of So we've got two things going. We've got the database that we've identified and just kind of did a lookup table based on map coordinates and stuff like that. And then we match that against what we find on the internet. So that's one thing that really helps on the OZ side of it. Otherwise, yeah, it's a combination. Let me look at our pipeline here. So just to kind of, give you an idea, because it's an interesting thought. So we've got 2 portfolios we're closing that were both through brokers. Then we have a good-sized park, 220 spaces in Memphis. That's an off-market deal, kind of direct to seller. We've got another one in North Carolina that's going to be our largest park. It's almost 500 spaces.
Wow.
And that's also kind of direct to seller. Fortunate to get that deal. We're super excited about it.
That's amazing. Yeah, huge.
Yeah. So yeah, I mean, it's a combination. It's kind of
combination. Sure.
It's some of both.
So would you say, one of the harder things then is to just, you have that extra filter of like an OZ zone, is that the hardest part of the business, just finding good opportunities to pursue?
Well, right up there with that challenge is operating.
Sure.
Right. I mean, just kind of really, really running these communities.
Especially with that growth, that massive growth. I mean, hiring that many people in and of itself could be difficult. So. Right.
Another buddy of mine who's in the business and his firm's been in the business a lot longer than we have. And I always like our conversation here, Andrew. I love just talking to other operators and kind of, sharing what we've learned, but also figuring out what other people know and trying to adopt. And it's just, I was sharing our org chart and our kind of how we're put together. And he's like, something doesn't make sense. He's like, there's no way that you have 2 regionals handling that many communities. Right. And so then we started talking about like, how do we divide the workload? Who's doing what? And so as I went through that and kind of described everything that our on-site managers are responsible for, his response was, well, okay, yeah, it totally makes sense. You're basically pushing a lot down to those on-site managers. And that's kind of been our attitude is like, we'll pay our on-sites more than probably most people will in the industry. And we get them health benefits and we get them 401k. You know what I mean? I mean, it's like,
it's nice,
they're like truly a part of the team, but we also expect a lot. So,
sure.
So that we're really kind of pushing some of that workload down to that level where they're, number of them are, so we've got Greenville, North Carolina. We have 5 communities there, about 500 pads. And we've got a main manager and then an assistant, but I mean, she's almost like a regional, right? That main manager. I mean, we've got the 2 of them really running those 5 communities. So paying them a little bit more and getting the kind of results that we insist on and that we're getting seems to be a good model for us. The challenge is if you go into new geography and your first park's 100 pads, like it's pretty expensive, right?
Yeah.
To run that with that kind of a team. And so we're always mindful of if we're going into a new geography, we need to make sure that there's a runway to be able to pick up some more communities to kind of amortize those costs. So
totally.
That's been our approach.
Totally makes sense. There's more than one way to skin a cat, right? There's a lot of different ways to set up management structure on these. Would you mind explaining to our audience what an opportunity zone is, and maybe a little more detail just to provide, some of the benefits that they offer to investors?
Yes. And people can run fact check on me here if I hope I get all my details correct. But I believe there are 8,700 opportunity zones in the country. And the way that worked, it was federal legislation, right? I mean, in other words, it's a federal tax credit, but it's administered on a state level, meaning the states were given the authority to go designate the opportunity zones. And I've read and I've talked to people, and I've heard a lot about kind of that process. And as you can imagine, it was a little bit political. For example, in California, the entire campus of Stanford University was submitted as an opportunity zone.
Jeez.
And I know you and I, we can sit here and laugh about it. In some ways, it ticks me off, right? Because it's like, well, obviously, if you do that, like that's a sort of thing that takes away from the credibility of what it was established to do.
Yeah.
Fortunately, the federal government was like, no, I don't think so.
Yeah.
And so there was kind of a check and balance there. But it's really, the opportunity zones, there's certain requirements they had to meet in terms of, income relative to poverty levels and all that sort of stuff. And so like I said, that was left up to the state governments. And then from there, it's really, the way I think about it is it's really pulling capital that otherwise would not be earmarked or invested in real estate into real estate. What I mean by that, like I spent a lot of years in the tech industry in the San Francisco Bay Area. So a lot of the colleagues that I had and just my associations are kind of in that area. And our latest Opportunity Zone Fund, I mean, I don't want to say 100%, but a high percentage of the folks that invested in the Opportunity Zone Fund, they weren't coming out of capital gain events in real estate. They were coming out of capital gain events with their stock options or with the business they sold or things like that. And there's never really been tax advantages for those scenarios. And people just, you sell a business, you pay your tax. You sell stock, you pay your capital gains. That's kind of what it's been. And this changed that. And to me, that's kind of the beauty of it, is that, why would somebody who works at Facebook and just sold $1 million worth of shares, how in the world would they ever think of, what I really want to do is I want to go invest in these communities that nobody else is investing in, that need help? I mean, even if they, that's how they felt, and that's how are they going to do that? They don't,
Sure.
They're not in real estate. They don't know, how to attack that problem. So anyway, and that's obviously, it was designed, you could only do it through a fund. So even if somebody said, hey, I want to do this on my own, they would have to establish a fund. You can't actually just do direct investment. So I think it was very well thought out. We're obviously in the early stages of it. In terms of, I'm sorry, I'm kind of rambling here, Andrew, so cut me off.
No, you're fine.
Dude, you're going down this rabbit hole, like, come back, come back. But the other part of that is, what are the impacts for the investor? Like, what does that mean? And there's really three tax advantages that an investor gets. So the first thing is, we probably have to chart some of this stuff, but in real estate, there's all sorts of tax advantages. One of them would be a 1031 exchange, right? So you've got your property you sell and you got to roll it into a new property. And when you do that, if you take any money off the table, right? So if you had all this price appreciation, you're like, well, I want some of that money and I'll invest the rest. Whatever you take off the table, whether it was original contribution or profit, gets taxed. In the Opportunity Zone, that's not true. So, if you sold something for $1 million and half of it, 500,000 was profit and the rest was your basis, you could take your basis off the table. So and there's no tax at all. You just have to roll in whatever the profit is, or at least if whatever you don't roll in does get taxed. Anyway, so the first thing that happens is that money that the capital gains of money that gets rolled into a fund, you're able to delay paying taxes on that, and that's it's out till 2026. So in 2026, you still have to pay those taxes. Now, the second advantage is so you get a deferral, you get a tax deferral. At this point, we're talking 5.5, 6 years. The second part of that is that you get a step up in your basis. So, and I was just trying to think about where we are in the timeline. I believe it through 2020, you get a 10% step up. So in other words, again, if it was $500,000 that you were investing, all capital gains, then you step that up by your basis by 10%. So basically, 50,000 of the 500 would not be taxed at all. So you'd only be taxed on the remaining 450. The third advantage, which is really to me, the biggest advantage, is that whatever appreciation happens inside the Opportunity Zone Fund is tax-free.
Wow.
So if you choose a good investment and sell it after 10 years, you have to invest for a minimum of 10 years. That could all be completely tax-free when you sell. And so again, that could be the biggest advantage. With just one more comment on that is that our philosophy a little bit is, a lot of these funds, say, hey, it's a 10-year fund and we plan to sell it year 10 or year 11. Our approach is actually you don't have to sell it year 10 or year 11. You can continue to hold it and it continues to grow tax-free. In other words, if you held it 15 years and sold it after 15, it's still a non-taxable event. If you hold it, you can hold it all the way out till 2056.
Wow.
And right now, if you sell it in 2056, you're still tax-free. And to us, we're like, okay, because you think about it, and this is what we describe to our investors, and nearly everyone agrees with us. Okay, yeah, this makes sense. Is if you sell, awesome, like you don't have to pay any taxes. Well, what are you going to do? I mean, maybe you want to buy a yacht, right? But probably you don't. Probably what you want to do is like, well, I got to roll that into something else that is going to generate income. Whatever that other investment is, it's obviously taxable if you were to exit that. So sure. We tell people we're staying in, because as long as we don't have to sell and we know that that's a tax-free event when we do, it makes more sense to stay in than it does to try to find another investment and have to pay taxes on the other one. So
totally.
Anyway,
yeah.
Long-winded explanation. Sorry.
No, I appreciate you explaining that. That's really, really high detail stuff. And I'm sure it can get confusing at points, but I mean, the value's there. That's tremendous. Sam, tell us what you think for passive investors interested in, investing in mobile home parks. What is the biggest risks that they face? Like when they're looking at deals, this could be on a micro level or a macro level. What are the biggest risks to, LP passive investors?
Okay, great. So yeah, like you said, so this would be just a passive investor looking at investing in a syndication or a fund.
Correct.
It's got to be the operator, right? So, definitely. You're going to find very few people, especially right now, that would not agree that the investment thesis of affordable housing makes a lot of sense, and specifically manufactured housing. But relative to even other commercial real estate classes, the operational risk is pretty high. So, that would just be my recommendation is you want to make sure you've got somebody that, has done it a few times, kind of knows what it takes, what to expect. And Andrew, I know you probably hear this all the time. It's like, hey, manufactured housing, it's like owning a parking lot. Like it's super easy. And like, I don't even know where that came from. Do you know? I've heard people say it, and some people even that are in the business. I'm like, first I was like, what am I doing wrong that they're doing right? But you realize like to really, at least what we're doing value add, right?
Yeah.
So, and to us that's what makes sense in this current investment environment. But if you're doing value add, you got to dig in, you got to get dirty. Communities that we've gotten up the ramp and they're there, they're a lot easier to manage. I don't know that they're even then, is it as easy or easier than a similar quality multifamily, I'm not convinced, right? I mean,
Sure.
because it's still, you still just kind of have the dynamics of people kind of, owning their own home in this community, but just the interactions that happen in that sort of situation versus an apartment building. Yeah, there's just nuances there. So, I mean, that would just be my main thing is you definitely want somebody that's experienced in doing this type of investment. Of course, I say that and everybody has to get started. You did, I did, and I'm fortunate that investors that had done some other things with us were willing to take a chance on us with manufactured housing. And it's been a lot of work, but it's been fun.
And do you guys have your own property management company? Because I spoke to some other fund managers that have tried third-party management, and there's a very few nationwide third-party property managers that manage mobile home parks. So how have you guys overcome that hurdle?
Yeah, you're right. I mean, we didn't even really take a serious look at it just because we had a couple conversations and it was just clear. My thesis going in was, even if we wanted to do third party at some point, before then we need to do it ourselves so that we know when we hire the third party, hey, here's what we want them to do.
Sure.
And so the way that we've looked at it is processes and systems, right? So people as well, right? And I kind of talked about the people portion of it. But in order to make people successful, like, we needed to have processes and we needed to have systems that made it easy and efficient for them to do those things. So I'll just give you a couple examples. We require each of our managers to do a weekly video. And so we buy a phone for them. So there's no excuses about my phone and this, and it's like, no, here you go. You get issued a phone. We put it on a plan, and then we set up these Google photo albums that automatically, as they take their videos, it gets uploaded, and then we're able to just easily, basically get a snapshot every week of, hey, here's what's going on. Here's this project over here, and we kind of coach some of that stuff. And then another thing that we do, we use project management software. So in our business specifically, because we're doing so many improvement projects, it was clear we needed project management software to ensure that we're meeting timelines and budgets and all that sort of stuff. And so we're using Asana. And what's nice is we're built on Google Apps. So all of our integrations are systems that need to be able to integrate with Google Apps. And so people, it's all synchronized kind of with your email and all these things. They take, sometimes you look and you're like, oh gosh, trying to train people on this stuff, because everybody just wants to use what they're used to, right? And
sure.
I'm not logging into that. I'll just send you an email, and it's I will not respond to this email. If you want a response, you need to go into, you just have to do that stuff, because human nature, we're all the same. We just like doing stuff we're comfortable with. So we just were real insistent on that sort of thing, so that we could use some tools that we knew would help us be more efficient. Our monthly bill on software is pretty steep, but I look at how would we,
gold, right?
Yeah, absolutely. How else would we do what we're trying to do without some of those systems? I don't even know.
Yeah.
I take multiple people. So
Totally. Can you explain a little bit about the value add components that you guys have implemented and in some of your current portfolio? A lot of our listeners come from other asset classes where they're familiar with the value add model. You build it up, you refinance and you hold, or you build it up and you sell.
Right.
Tell us a little bit about the value add that you guys have implemented, and what was the harder ones and what were easier.
Cool. So you mean just in terms of what kind of projects we did?
Yeah.
Okay. Yeah. So I'll just go over kind of some of our maybe budget wise, dollar wise. So a lot of times if you're buying one of these older communities, they're typically built in like the 70s. I don't know. That seems to be like, I don't know what happened in the 70s exactly, but man, I tell you, like, I think 80% of our mobile home parks were built in the 70s, right? So you think about that and it's like, okay, so that means probably your sewer lines are 50 years old. A lot of your water lines are 50 years old. Your electrical distribution and pedestals, some of those things are 50. You know what I mean? You just kind of go down the list. You're like, okay, like, yeah, that's probably rated for like 20 years, right? Yeah, I mean, some of this stuff. So, we've repiped entire parks, right? Sewer lines, water lines. We just got done completely redoing some electrical, not only the pedestals, but having to redo distribution lines. And then there's the more obvious ones, right? Which is like the roads. Mm-hmm. What we found, I don't know your experience, Andrew, but what we found, it's like when people are remodeling a house, right? You can go online, you can look up, hey, if you want the most ROI for renovating your home, like start in the kitchen, and then it's the bathrooms and it's the master suite, whatever. I think, this is not scientific, but our experience is if we redo the roads, man, like it just attracts people. Everybody's happy. It seems to be the big thing that really is impactful for the residents and for prospective residents. So we almost always do that to, somehow. Sometimes the roads are in pretty good shape. It's like, well, we'll reseal them. Like that's just what we do. Typically within, a short time of owning the community. And, so that, here's another one. I don't know if I shared this with you before, but we were looking at lighting, and we, as you know, in the industry, a lot of people have used gamma sonic, and that's kind of talked about. And when I say lighting, solar lighting, right? LED solar lighting. And so we tested out, we purchased a couple gamma sonic poles and lights, and we kind of, I'm an engineer, my brother Luke is an engineer, and we just, so we look at it and look at the specs. We're like, that's not very bright. I don't think, sure enough, we get it in. It's like, well, it lights up a little bit of area, but not what we wanted. So we've got a project manager here, Fletcher, and I said, look, you don't have to figure this out overnight, but like, I'll give you a couple months. We need to figure out a good solar lighting solution. Like we need, so that when you talk about like impactful projects, asphalt's huge, lighting up a community so that people feel safe, and it right, it just at night. That's sure. A big deal and that's probably number 2, I think. And so, I told Fletcher, I was like, look, this is probably going to take a little while, but we're going to need to do some testing. Like we need to make sure, how bright are these? How do they work? Yeah, it took longer than 2 months, probably took 6 really. But what we ended up with is street lights. They're 17 to 18 feet in the air, and they literally light up like a street light. So they'll light up a radius of like 50 feet.
That's great. And what's the brand on those?
It's called Tenku.
Tenku.
Tenkoo. It's a Korean company. And
cool. You saved me 6 months right there.
No, absolutely. No, actually we have Andrew, we have a whole manual we put together because like I said, this was something that was important to us. We've had a lot of people share with us, and we're like, you know what? Let's go ahead and put a whole manual together. Here's all the parts. Here's how you put them together. Here's how you cement it. And anyway, so I can send that over to you. It's something we developed for ourselves, so that as we do it with these different parts, we can just kind of hand the manual to that manager and their staff and kind of make it happen. But we've got we're putting 50 of them in a community down in Texas, and it's exciting, right? The residents get excited about that as well, because that's a big complaint, right? If you have any sort of crime or concerns about crime or visitors or whatever, They have an auto sensor on them, so they'll kind of be in a dim mode, and then somebody drives or walks by, and they brighten up significantly. And
wow, that's very cool.
So and we've got it down to about $800 for the whole assembly.
Wow, that's fantastic. Yeah, I'd love to get that manual for sure, and I'll put that in the show notes. But
awesome.
Tell me in regards to like NOI value add to, increase the NOI. Obviously infill has been one of the big ways to do that, and it's kind of known as like the hard way to kind of increase NOI. Yeah. Would you agree with that? What struggles have you come across through that process? And maybe is there some utility bill backs or other things you've done to actually affect the bottom line besides obviously the CapEx that you mentioned previous?
Yeah. So yeah, you're certainly right. The infill it's an important piece, but it's not the easiest way to improve your net operating income. So for example, we purchased 2 communities in Phoenix City, Alabama. Part of Columbus, Georgia. It's kind of right across the Chattahoochee River there, but it's really part of Columbus. And it is probably our worst market in terms of median income, median home price, what is a 3-bedroom rent for, all that sort of stuff. And we've had fantastic results there. Now, that being said, we bought 2 communities. One of them was actually 90% full, but was losing money every month. I'll explain that one in a minute. The other one was 126 spaces with 100 park-owned homes, and 70 of them were vacant.
Oh my goodness!
It was like, oh man, and this is one of our first acquisitions. It was tough. But what we said is, you know what? We believe, even though we didn't pay much for those homes, we know that there's value there, and we think we can extract it. And so we don't let anybody move in as a renter. We want communities where people own their homes. A lot of times you got to give them a path to get to the home ownership, and so we use, like a rent credit lease option type contract. And so what that means is that even if somebody's buying a home that we didn't renovate yet, right? So we give them 3 months of free lot rent and they fix it up or whatever. Even then, we require at least $1,000 up front, just for that part of it. And so in 18 months, I guess, we're at 2 years now. I think we have 7 or 8 homes left out of the 70.
Wow. I'm sure we could have a whole episode just about that one community.
Oh no! That it's been amazing. But the funny thing is we had some vacant lots as well. Not that many, but we were like, well, we're going here with the used homes, and then so it's like we had the homes we renovated, we had the homes that needed renovation we hadn't got to yet, and then we were like, well, let's do some new homes as well. I'm trying to remember exactly, but it took over 6 months to sell 2 new homes in the community. I think now it would go a lot quicker because it's mostly full, and we've kind of got more momentum there. But I guess my point is, depending on the market, infill could be super challenging, right? Because it's, like I said, it took us a long time just to sell 2 homes in that market. If instead of vacant homes, we just had vacant lots, I'd be telling a different story about that park, I'm pretty sure. So, like I said, most of our target markets, we have the fundamentals are better. So that, for example, we own one in Marietta, Georgia. We bought about a year ago. We've brought in about 35 new homes there so far, and we have a waiting list for new homes there, right? Wow. So it's obviously market dependent, but that would be the thing, is that in this market, it's hard to get homes, it's hard to get inventory. So if you're in a geography where it's going to be harder to sell new homes, got to be pretty creative with how you bring those, how you infill your community.
Sure. Have you brought in used homes to communities, and then where do you get your new homes? Are you using like the 21st Mortgage Cash program or something similar?
Yeah. So we've done some used homes, very few. I mean, like just a handful. Like I said, I mean, we kind of weigh it out of the used versus the new, and just used homes right now, they're selling at a premium, right? I mean,
sure.
Unless you know something I don't about a good source there, but just from what we found, people that's their business. They kind of know what they have. They know that it's 6-month wait from Clayton and whatever, and they're like, I'll sell you the home, and here's what it's going to cost. So we've just said, for that price, we'd rather buy a new home, typically. But what it has done is this situation I was describing where we've got a whole bunch of vacant homes. I think we would probably be inclined previously to, if something needed more than, let's say, $7,000 worth of work, it's like, well, let's yank it out and bring in a new one. We'll dig a little deeper into those, and we'll take on a bigger home renovation than probably we would if the market wasn't so tight for used inventory. As far as new homes, we pretty much have just used 2 vendors so far, Legacy, and as you probably know, they have their own financing arrangement, and then Clayton. And we've done their True product, and then we're buying quite a bit out of their Maynardville plant. We've used 21st, and we're getting set up with the First Bank as well. If you know those guys, they're out of Knoxville as well. So yeah, that's kind of been
very cool.
How we're doing the info.
Yeah, that's
how about you guys? What do you, I realize maybe I'm supposed to be answering, but I'd love to hear what you guys are doing for that.
Yeah, no, I mean, we've used Legacy before. We've done the 21st Mortgage Cash program. Prefer Legacy, just was a little bit quicker. And then we do infill a lot of used homes. That's kind of my specialty. I started out as a Lonnie dealer. So we'll have to connect on that.
Soon. Absolutely. Okay.
Quick question, Sam. What does the perfect mobile home park look like to you? After being in the business, where would it be located? What kind of tips would you give passive investors that are, say, looking at a syndication deal? Where, just a real quick deal review, what are the top things you would look for so that a passive investor can say, yes, this is a good deal, or no, I don't like this. The median home values in the area are $30,000 or something like that. And that would be, an X.
Yeah, maybe I'll start out like high level and kind of drill down a little bit, but
sure.
I would start off thinking about like, what is the geography that you want to invest in, meaning just, general area of the country. So for us, we went through that exercise and we decided that what we really like is the Southeast. And when I say the Southeast, it can swing all the way over to like Texas, right? And kind of the lower Midwest. But anyway, so, the reason that we like the Southeast is generally very business-friendly government. Generally, long-term demographic trends are positive with people leaving colder climates, coming to, generally warmer climates as the population ages and all of that. And just success begets success, right? So when you've got Toyota and BMW, I'm just thinking of these different markets that we're in. We're large. When I grew up, it's like if it was an auto manufacturer, it's in Michigan. Like, what are you talking about? Tennessee? I mean, I've never heard of that. Or South Carolina, but that's what's happening now, right? Alabama's really. I love Alabama. They've been very thoughtful and I think very proactive about bringing business and the right kind of business to the state. Obviously, Texas is, everybody knows that story and kind of what's the explosion that's happening there. So I would start there and just kind of think about the geography. In terms of more specifics on geography or because, look, if I say the Southeast, I do not mean like Podunk Town, Mississippi, right? Because you're going to get crushed.
Sure.
I've looked at a lot of opportunities in the Southeast that, didn't get past 5 minutes because you pull it up on best places and you figure out, this place is dying. And that happens all over the country. But there's certainly areas in the Southeast that you would generally very rural that you want to avoid. Yeah.
And like just to comment on that, I'm on a list of a bunch of repossessed homes. And every month I get an email of that list of repoed mobile homes, and Mississippi and Louisiana always have the most homes that are being repossessed from usually private purchasers that have purchased direct. So interesting that, you got to watch out for some markets.
Yeah, we should probably set up a trucking company from Mississippi to, Alabama or something. We might make a lot of money just pulling homes from one place to the other.
Oh, geez, yeah.
So it's crazy, right? I studied this a little bit one time in terms of when you've got bordering states that have, different philosophical government policy and sometimes it's income tax or whatever, but just you can see these stark differences in what are otherwise like the same place. But you look at, most of Louisiana, for example, versus Alabama. I mean, Alabama 25 years ago, when I lived in Georgia, Alabama was Mississippi and Louisiana. And it's amazing kind of what they've done to turn it around. But from there, it's kind of the general things I'm sure, Andrew, you guys look at are like, in that city, in that MSA, what is the population? Is it growing? What's the economy? What are the top employers? How long does real estate sit on the market when somebody's trying to sell it? What is it? Charles Becker out of Duke University did, he studied the mobile home park industry, and one of the things that he's concluded is that really the replacement housing for manufactured housing are 3-bedroom rents. It could be a home, could be an apartment, but that's really the very best proxy for your mobile home, or in a mobile home community. And so that's a big one we look at. We definitely want to see a strong 3-bedroom rent. So that's kind of the next thing that we look at, and obviously you want to pay attention to where is that community in the town, and what is the crime rate like there, and generally what are the schools like. We don't get too bogged down in some of that stuff though, because again, it's affordable housing. If we said, hey, all the schools have to be magnet levels, it's like, well, we probably wouldn't buy mobile home parks because there aren't hardly any in those areas, right?
Sure.
So then from there, I've been thinking about that question as soon as you said it in terms of like the ideal mobile home park investment. I think my favorite so far are communities where the previous owner, usually a mom and pop owner, very hands-on, and they made the decision that they were going to fill up their park and they were going to keep all their homes. So they rent out their homes. And I love buying those communities where they're like highly occupied, have a whole bunch of park-owned homes, because we've shown and we've proven to ourselves, hey, we can sell off those homes in a relatively quick amount of time, and we can reallocate value or rent away from the homes and towards the lots in the communities. So, for example, we've got a small portfolio in Greenville, South Carolina, that we're going to be purchasing here pretty soon. And their average lot rent is $170 a month. The market's probably $350 to $400. Now, but again, it's almost all park-owned homes, and they're attributing or allocating $400 to $500 worth of rent to the home. So what we're going to do at acquisition is we send out a new lease agreement, and it's like, okay, maybe your rent went up $25, but the important thing to us is that your allocation between your lot rent and your home rent just flipped, right? So now your lot rent's $350 or $400, your home rent's $150, and then we start selling off the home. So we're able to capture quite a bit of that value while also offloading those expenses. And because what's nice about that is you're turning it from a real kind of renter mentality community into an ownership community. And it's like it switches, like when that switch gets flipped, it's such a difference going to that community where it's like all of a sudden people have gardens, there's just a care and a concern that they have that you never saw previously. And so I love that. But economically, it's great because while we transition, we've got a ton of cash flow, right? So we're kind of, it's cash flowing from the time we, like this one in Greenville, when we include all of the income, right, from the homes and the lots, we're at like a 12 cap going in. Now, it's not really a 12 cap, right? Because I don't consider the home income as recurring revenue. And that's like a 67% expense ratio. I mean, that's with heavy expenses, which we know we kind of need when you've got all those homes. But as you start selling those off, your expenses go away actually faster than your income, right? Because you're now pushing that to the residents. They're taking care of it themselves. And so that transition's great. And then once you reach the other end where you've got mostly tenant-owned homes, there's like, it's like an arbitrage, because all of a sudden the banks like it. They don't like park-owned homes. They love tenant-owned homes. And so now you can get super cheap debt and you can get more leverage, and it just like the value of your asset just went up significantly.
Yeah. And that is different than a lot of other operators that I've spoken with, and different from our model, because do you guys have a certain way you pro forma that up front? Do you say, hey, we have 100% park-owned homes, upon acquisition, we expect a third of them to stay, a third of them to leave, and a third of them to continue renting? I've heard that model before. How do you guys kind of pro forma for which ones you're actually going to be able to keep occupied?
Yeah, no, we typically, based on our experience, it's about 25 to 30% don't want to own their own home. They're like, hey man, I'm a renter. Like, there's no way I'm fixing the toilet when it starts leaking. Like, I need to call somebody. You know what I mean?
Sure.
And so so we include in the pro forma, okay, we're going to probably need to do a make ready on this percentage of these homes. And then we kind of project it'll take on average like 2 to 3 years to transition most of the community. And that's what it's been. So, yeah, I know what you're saying, because a lot of people I talk to, like, they don't want to mess with that, and they don't.
Yeah, it's more work.
That's fine with us, because it's more work. It's definitely more work. But we've been able to do it a few times, and so that's probably great. My favorite kind. Yeah.
Wow. Well, that makes you different in the history of the show interviews. So kudos for you, man. I'm sure you'll get more deals because of that. That's awesome.
I think so, right? Just because a lot of people look at that and say, yeah, I'm not.
Yeah.
I mean, the thing is, it's like, so whether that home is currently vacant or currently occupied, you and I know this. It used to be in the industry, you could have a vacant lot and dealers and other people would bring homes in. Like, that doesn't happen, really, not much.
Yeah.
So one way or another, you've got to get a home on that lot. I'd rather it was already there.
That's a good point. Than bringing a new one in. Yeah.
Bring it in and pay, $7,000, $8,000 to get it shipped, set up, skirted, all the rest of it. So yeah, that's just kind of how we look at it. And there's a little bit of friction as we kind of transition stuff and some challenges, but it's worked out well for us.
That's fantastic. Last question. What are the typical general partner, limited partner splits, and are you raising capital now for that fund? And what are some typical fees that investors could expect?
Okay, yeah. So generally, we'll have a preferred return. Depending on the deal, it's usually 6 to 7%. We generally do like a 70-30, 40-60 or 70-30 split, and then there's usually a second tier where it goes to 50-50, which means probably investors getting 14% or whatever by the time it gets to that split. So that's pretty general for us. We charge property management fees. We have an acquisitions fee. We have if we refinance a property, we'll take a 1% fee there. trying to think if I'm missing anything there. On our Opportunity Zone fund, we also charge an asset management fee. And the reason is there's just, for every community in an OZ, there's heavy lifting. So we have to have the personnel in place and everything to kind of manage all of that. So it's just more expensive for us. And the way that we do that, because we're like, we want to align incentives. It's like, okay, so if we're doing a 10-year fund or an evergreen fund, like I talked about in an OZ, over time, all of those got fixed up. Do we really need that fee? I mean, as much as it'd be great to keep collecting the 2% fee, it's like, well, that's not needed, right? I mean, once we've renovated those communities and they're stabilized and, we're not doing those major projects, we don't need that fee. So basically, the way we have it structured, once we recapitalize and return investors' capital, the fee is just based on their contributed capital. So as that goes to zero, that asset management fee goes away. So that'd be the one difference with the OZ fund. But yeah, other than that, that's kind of how we're structured.
Wonderful. Hey, thank you so much for adding value to our listeners and for coming on the show. Sam, how can people get a hold of you if they want to reach out?
Awesome. Yeah. So probably best place would be LinkedIn. I'm on LinkedIn. I guess it'd be like /Sam Hales, I believe. I think I was the first one on there, first Sam Hales on there. Or my email is sam@Saratoga Group, SARATOGA, and then group.com. So those would be a couple of good ways to get a hold of me. Andrew,
Awesome.
Thanks so much.
Yeah, thank you so much for coming on the show. To all the listeners out there, if you like this, please hit the subscribe button to get signed up to receive all of our future interviews with other rock stars like Sam Hales. That's it for today. Thank you all so much for tuning in.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021. And it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.